Hi, Larry Gaines, Power Cycle Trading. Well, in this video, I want to show you two directional trade setups for potential upside moves. So this is best buy, and this is what we call a volatility squeeze. So it's been kind of price churning, coiling, has potential to break out to the upside. So if it breaks here, the 77 level, the next target would be potentially up here to that prior high at close to 80 bucks, 79.80 to 80 bucks, and then after that, potentially up to 83. But a couple different ways you could trade this. So you could do just buy calls for a directional move up. You could do a call debit spread for a directional move up, or you could also look at a butterfly that you could then convert to a ratio butterfly if this thing started to falter on you. So let's take a look at those setups. So one trade would just be to buy, let's say, the 77.5 calls, pretty close to the money. So you pay, say, $1.20. All right, so let's take a look at that one, and then let's compare buying calls to a call debit spread to a butterfly. So if you're to buy the call, the 77.5 call for next week's expiration, $1.21, that's going to be the best potential profit. So if we got to $80, this would be up close to 130 bucks. Now the negative is that the theta decay. See that? So this is going to lose 11 cents every day, and that's going to increase. So for example, if it's trading at 77.5. Hold on one second. So at the end of this week, on the 10th, if it's trading at 77.5 and has not moved, this trade will be down $23. Okay, so that's that theta decay kicking in. So the other type of trade could be called debit spread. So you could buy the same series. This is the AUG 24. Let's take a look at going out to next week's expiration. One second. So you could buy next week's expiration, the 77.5 80 call debit spread for 84 cents. At risk 84, potential profit 166. So that's 2 to 1. Nice risk reward ratio. And look at the theta decay. It's $2.66 versus if you looked at just going long that call spread at not the call spread but the call outright, it's $6.49. Now the other possible trade setup directionally would be the butterfly. So if you did the butterfly, same expiration, do the 77.5, 79.5, 81, $2 wide balanced butterfly. You could do that at $43 debit. So that's your maximum risk. So your total risk is 43. Now if it goes out exactly at 79.5 at expiration, that's your theoretical max profit, which would be $157, which would be a 365% return. So by far that'd be the biggest return. And then look, theta, you've got actually positive theta because this is you're selling, a bear call credit spread in here. You're actually selling to the 79.5, so you get that positive theta right there. So that's another way to play it. And for a directional move up, looking to target this area in here. So a couple of different ways, and just shows you the differences between those two or three different types of directional trades. Number one, just a long call. Number two is a call debit spread. Number three would be a butterfly. The other thing I like about the butterfly is that you could also convert this to what we call ratio butterfly. If it started to fall, you could sell another 79.5, 81.5 call right here, call spread, creating this ratio butterfly, so dropping your risk down to $13 only to the downside. Hope this helps. Talk to you on my next video.